the market leader for U.S. Bank Twin Cities. Office here out of Minnetonka. It's a lovely day out there. Like I said just a minute ago, we've done a number of these before. We're going to turn over to Jeff here in a second, but mainly it's about 1031 and commercial real estate. So some of the things we're seeing and why it's such a hot market right now. Obviously, anytime you're starting off an interest rate with a number 2, and that's how low rates are right now, it's a hot market. SBA, some really good programs for owner-occupied, making industrial really hot as well. So we're seeing a lot of activity, a lot of people looking right now. I know we've probably got some commercial real estate brokers and real estate owners on the phone now are probably feeling the same things we are. But it is a hot market. Y'all don't want to hear me talk, so I'm going to turn right over to Jeff here. But before I do, we are going to be doing questions. If you have any questions, there is a chat feature within here. We have everyone muted. So please write your question in the chat feature, and I'll try to get to it later. So Jeff, you want to give your intro?
Well, I totally agree with you. Our business has been going gangbusters for 48 months. We are busy. There is great velocity in the real estate market, and most of our exchanges are being done by the mom and pop investors. So people with duplexes and triplexes, farmers, small business owners. We occasionally get, the big mega $10 million or $100 million deal from a corporation, but most of our deals are small mom and pop, and that's where the velocity in the marketplace is. It's the small stuff. There are also some real significant soft spots and fragility in the marketplace. So entertainment venues, restaurants, hotels. I don't think we're going to see that come back to normal maybe till 2024. So we have a funny marketplace where it's really hot in some areas and extremely fragile in others. I had a conversation yesterday with a person that was selling a business property in Colorado. They were expanding their business into Florida. Well, the good news is the Colorado market is really hot. They're going to have no problem selling their relinquished property. The bad news is the market in Florida is even hotter, and to be able to find and locate their replacement property, competing against purchasers that are buying stuff sight unseen, just sending in, over asking price bids without having even looked at the property, they're in a tough market to replace their replacement property. So the first thing, Matt, that I'd like to kind of emphasize is that the nuts and bolts rules, that when you sell a relinquished property, and that's day 0 for computing both your 45-day identification period and your 180-day exchange period, those rules were created by the Treasury in their Treasury regulations, not with investors' success in mind. Those rules were there to stymie and limit the number of people completing exchanges. And you really need to know what the rules of the road are before you start this process so that you can conform your behavior and succeed. Matt, imagine that I offered you $10 million for your investment property. And you're thinking, well, great, that's $10 million, but I don't know what I'm going to exchange into. One technique that we're seeing investors use is they say to the buyer, hey, that's a great offer. I'd like to accept your offer contingent upon the seller being able to pick the closing date. I might even lease the facility to you in the interim, but I need to be able to pick the closing date because everything tracks off of the date of closing. So day 0 is the day of closing. So if Matt Thompson can control the closing date, then he can control when he gets painted into that 45-day corner for identification. And so you may kind of tap the brakes on the closing so that you get more time to hopefully tie up a replacement property, at least do your homework on what you want to do for a replacement.
Yeah, Jeff, at least one question we already had in here. So if you can't find a property, what are some vehicles or where can you, say, park money? I've heard people putting in a REIT or Delaware Statutory Trust. Where can people park money in order to avoid that 180-day time limit?
Well, that's a really good question. You know, there's two realms where you can search for your replacement property, which has to be real estate in the United States that's held for investment or business purposes. The big realm is the traditional brick and mortar realm. That's the realm where like Tom Tracy and real estate brokers work in that, you know, will sell you an office building or sell you an apartment building or sell you a farm, traditional real estate. But then in the other realm, which is the securitized realm, where companies like Ameriprise and Cantor Fitzgerald, Inland, AEI Fund Management, they have products that are marketed and regulated as securities, but nevertheless also constitute real estate for federal tax purposes. So if you can go to your Cantor Fitzgerald or Ameriprise financial representative and procure a replacement investment that's already been vetted and approved by their institution, that's a great way for you to redeploy your cash and just get something that's completely management free. Your management really goes to, you know, getting to the mailbox to pick up your monthly or quarterly yield check that's sent out to you by the syndicator. It's a great option. And right now, because the market is so hot, people in Minneapolis and St. Paul are looking at higher taxes, greater regulation, more potential difficulties with municipal and government authorities like rent control, rent stabilization. And they're saying, hey, I'm just tired of this. I'm going to sell these apartment buildings at the very top of the market, and I'm going to redeploy my cash into these Delaware statutory trusts or DSTs that give me, you know, management-free alternatives to having to deal with toilets and tenants and all the troubles, the 3 T's of property ownership. So that's a great question.
Yeah, the tenant's pretty odd right now. I think everyone knows there's no eviction from the governor right now, so it makes it definitely challenging for landlords. Once you go into a REIT or a DST, can you take that back into commercial real estate, do another 1031, say 4 or 5 years down the road when the market softens?
Maybe.
I know there's fees coming out of DSTs.
Yeah. Maybe. I am not a financial securities person, and I don't sell any products and I don't sell any investments. I'm just a humble administrator facilitating exchanges. So I'll just tell you what I see. Some of the DSTs are designed to be like a mini REIT, a portfolio of maybe 3 to 7 or more properties. And that little portfolio is going to have investment benchmarks. When the portfolio meets its benchmarks, the syndicator will sell the portfolio, and all of the investors will then have an opportunity to either cash out and pay their taxes or to do another 1031 exchange. And that may happen 3 years from now, or it may happen 10 or 15 years from now. We don't know exactly. So companies like Inland, AEI Fund Management, Cantor Fitzgerald, I believe, have products like that are kind of little portfolios onto their own. And those will have an exit at some point in which you'll be able to then go back and do another 1031. Now, other sponsors have a DST that is designed after a period of time not to be sold, but to go up into a REIT. So the property that is in the DST is going to be absorbed under Section 121, which is the contribution of property to a partnership. So this is called an UPREIT partnership. And the plan is to absorb the property into the UPREIT so that the investors are now in a big diversified REIT, or the equivalent of being in the big diversified REIT. And that is kind of like the Hotel California, Matt, because you can check out, but you can't ever leave without triggering the taxes. Well, Matt, let's assume that you've got 4 children. You've been very biologically successful. You got 4 children, and you plan on dying sometime in the future. Now, we can't say when we're going to die, but we can say we are probably going to die someday. All right. So the thought process, Matt, you sell the property for $10 million, you put it into the DST morphs up into the REIT, and then sometime in the future you die. Well, REIT shares are usually more divisible and liquid than traditional brick and mortar real estate. So as part of your estate planning, you can say, well, Susie's going to get 25% of the REIT shares and Bobby's going to get 25 of the REIT shares and so on. And the children then can have the control whether they want to sell their REIT shares as an inheritance with a stepped up basis and just take their money cash free, tax free, or if they would just want to stay in that nice management free REIT and enjoy the steady Eddie stream of income. So those kinds of DSTs that become REITs are really attractive to people that are doing estate planning and have lots of siblings or children that they want to give their property to after their passing. Just depends on what your plan is.
Hey, one of the questions that came in is about reverse 1031s. What do you see in reverse 1031s, and maybe give a little details on how that's going right now?
Well, we're seeing a lot of reverses right now because it's really easy to be a seller of your relinquished property. It's much harder to be the buyer because it's so competitive. Inventories are tight and there's a lot of competition for the same properties. So Matt, if you find the replacement property that you really want, maybe the smart play is to put your energies into buying the replacement property first in a reverse exchange. And in a reverse exchange, really it's the qualified intermediary that generally forms an LLC and purchases that replacement property. And rather than having the taxpayer grant a mortgage to US Bank, the intermediary's LLC is the buyer of the replacement property and grants the mortgage to US Bank. The taxpayer may funnel the down payment in, but what I want to emphasize to you is that the intermediary acquires the property and holds it for up to 180 days so that you then have time to sell your relinquished property. And then we take that parked replacement property like a can of Campbell's soup and we pass it to you to complete your exchange. So you don't have to sweat the 45-day identification period as much because you've already acquired your replacement property. Now, the thing that you probably have picked up on is the financing piece is a little bit more tricky because you're accustomed to having your mortgagor be the economic participant, not the qualified intermediaries LLC. So we do have a little bit of a challenge with the financing piece, but you're also, as the lender, allowed to take a personal guarantee or have a co-signer, which can be the taxpayer.
Yeah. Shameless plug. We have gotten those done, lending with reverse 1031. So,
absolutely. Yeah.
Hey, one other question we get, if you made a lot of capital improvements, HVAC, to a commercial property, anything else like that, are those items included for deferring 1031 capital gains? Does that reduce your tax burden?
There's a little bit of a change in the way that the service is approaching personal property. What is personal property? It's chattel. It's non-real estate. And, for a long time, maybe 3 decades, the IRS just kind of took the position that if the state of Minnesota considers the water heater that's plumbed in as a permanent fixture and a component of the real estate, then we're going to go along with that and defer to the local state. Recently, some new Treasury regulations were released by the service. They're like 130 pages long, defining what is real estate for purposes of 1031. And I don't think we want to get down into the weeds too much, but generally speaking, fixtures, that plumbed in water heater, are still considered components of the real estate. But there can be some exceptions if it's specialty HVAC or specialty water heaters for a particular extra use over and above the standard infrastructure of the building. But generally speaking, those components are still considered real estate, and they can be exchanged for other real estate. Now, the thing you got to be cautious of is people that have done cost seg studies where they parse out the various components for more rapid depreciation. They're creating what we call 1245 gain or accelerated depreciation. You need to be cautious in those situations to make sure that your replacement property has a sufficient amount of 1245 components so you can match up your 1245 gains with 1245 replacement and putting them together. But that's hard to do if you're buying raw land as replacement property, because there's no, generally speaking, any 1245 in raw land. Now, what do we say? We say surround yourself with the best and the brightest advisors. So bring your accountant into the equation early on these kinds of issues. Bring your attorney in, bring your banker, of course, bring your qualified intermediary to the party. And if we're all doing our bit, we can navigate these kind of choppy waters to get you to the other end of the lake.
All right, I had another one pop up. I'm going to read this to you, Jeff. Is the 1031 to 721 process only available through a financial product, or can investors do that process on their own?
They can do it on their own. We do see people that are buying replacement properties with a co-purchaser. So Matt, let's say that you sell a property for $5 million and your brother-in-law has $5 million, and you say, well, let's go buy this, $70 million property together, and we can't pull it off ourselves individually, but together, if we buy the replacement property together as tenants in common, we could probably muster up enough cash between your 1031 and your brother's own money, and you guys would buy the property as tenants in common rather than as partners. Because Matt Thompson doing a 1031 exchange can't buy an interest in a multi-member entity or joint venture or partnership. Matt Thompson needs to buy replacement property. So a tenant in common interest in the real estate will qualify. But going forward, you and your co-purchaser may decide that it doesn't make sense to be separate co-owners, tenant common owners of the property. And eventually you may want to each contribute your co-tenancy or co-ownership interest to a joint venture entity. And down the road that could occur. So you can do a private 721 contribution. Those are probably the more conventionally used, or that's the way it's more traditionally been used in the past.
All right, that led to another question that popped up. So can you sell a commercial property into undeveloped land, or 1031, excuse me, from
Yes.
Commercial property, undeveloped land? You can't do that. Okay.
Yeah, you can. And remember, surround yourself with the best and brightest. Make sure that you're talking to your accountant, because like we talked about, you could have 1245 gains in your developed property, and you'd potentially not be able to match up your 1245 gains if you're just going into dirt. So there could be a little sliver of gain that would have to be dealt with. Remember, you can also buy multiple replacement properties. So if I'm buying a piece of dirt, but I also need to buy something that's heavily laden with 1245 property, I can buy two properties as long as I identify them each within my 45-day period. Great questions on this snowy and cold day.
Yeah, they're coming. One of these was, I already had written down, and someone just asked the same one. So if you have an LLC and you're selling a property and only one of two of them want to do a 1031 exchange, how does one achieve that or do that?
You know, I was at a conference and I made a joke that I want to have a hot tub time machine, making reference to the movie where they time travel back in time. If I had a hot tub time machine, I would go back in time 2 years and I'd say to these people, hey, maybe you should reconfigure the ownership of this asset into tenancy in common so that each of you can accumulate and accrue time in your individual separate ownership capacities so that you can do an exchange when you eventually decide to sell it in 2 years, you know? But we don't have a time machine. And oftentimes the clients are coming out with this, you know, right before the sale is going to happen or right before they're going to list it. There are some various techniques. Some are very crude and unsophisticated where you just break it up as tenants in common and cross your fingers that you've held the property long enough. And other techniques that are referred to as spin-offs. That works great if you've got an LLC or a partnership or entity that's taxed as a partnership, because you can spin off subsidiaries under Section 708. And those subsidiaries are considered continuations of the predecessor for tax purposes. But the nut that I've never been able to crack, and I've never seen anyone figure out, is how do you reconfigure the ownership when the real estate is owned by an S corporation or a C corporation, because distributing the asset out of the entity can trigger the gain. And it's much harder to try to do a reconfiguration of a corporation than it is an entity that's taxed as a partnership. This is a planning opportunity. Everyone that's listening to this webinar should say to themselves, if I've got clients that own properties in LLCs or partnerships, and the partners don't really get along anymore and don't want to be together, that is a planning opportunity. And we should surround the client with the best and brightest advisors, from the accountant, the lawyer, the intermediary, and the banker, and figure out how to reconfigure the ownership early so we have the most airtight and defensible exchange. The risk is that the IRS says, hey, buddy, you only held your tenant in common interest for a short couple of days before selling it. Does that really satisfy the holding period for 1031?
All right. I'll someone summarize that answer for me later. That was good. Thanks, Jeff. All right. One question we get is, if you own multiple properties and say you want to sell one and use 1031 proceeds, either retire debt or do improvements or expansion on another property, can you do that if it's owner of the same entity?
It's a really good question. You know, the word exchange is part of the code section. And if you're going to do an exchange, that seems to indicate that you have to acquire something new that you didn't already own. I don't think you can take your sales proceeds from the disposition of your relinquished property and pay off debt on property that you already own, because I don't think the IRS views that as an exchange, because you haven't received anything new that you didn't already have. And for many years, the IRS took the position that building improvements on land that you already owned did not qualify. There has been maybe a little bit of cracks in the veneer with some private letter rulings that have allowed people to construct improvements on leasehold estates that exist on land already owned by the taxpayer. So there is maybe a workaround. It is the deep end of the swimming pool for 1031. There's a way perhaps to do it, but you're swimming upstream. You're going contrary to decades of precedents that constructing improvements on land that you already own doesn't work. Again, got to surround yourself with the best and brightest CPA, lawyer, banker, intermediary, and there may be a way to figure it out. But if you want my advice, the easiest thing is just to go out and buy something you didn't already own from an unrelated third party. That's the easiest way to fix the problem.
I think that leads into the next question. Can you combine two properties into one larger property in 1031 exchange?
Yes, yes. Now, the
All right.
question is that new property big enough to accommodate two sales? Because you generally have to go up or equal in value, up or equal in equity, and you have to offset your debt relief. So if that new acquisition is sufficiently large, we could accommodate and absorb two exchanges into that bigger, better property.
All right, thanks, Jeff. I got another one here. I think you kind of hit on this already. Someone develops a tract of land into 10 residential parcels to be qualified for 1031 exchange. One may have to sell all of them at the same time, or do you have to sell them one by one? Or not one by one, excuse me. That make sense?
Yeah, Matt, if you bought a piece of dirt and you chopped it up into 10 little lots, filed the plat, put it in the infrastructure, do you think the IRS looks at you like you're holding it for investment or business purposes? Or do you think that they're looking at you like you're a dealer, like this real estate is your stock and trade, your inventory? The problem with chopping up land or doing condo conversions or any other dealer activity is that you can start to look like you're not holding for investment, but holding for resale. Flippers have the same problem. People that buy houses, rehab them, and immediately sell them. Dealer property does not qualify for 1031. So again, surround yourself with the best and brightest, because there may be some ways to conform your behavior so that you're not viewed as the dealer that's peddling this stuff to the public. And maybe you want to abstain from the dealer actions, filing the plat, putting in the infrastructure, selling them individually to the public. Maybe that's not the game that you want to be playing if you want to be perceived as being a holder for investment or business. Maybe you should offload that job to the next guy. And I think that's what the questioner is asking.
Yeah, I believe so. Well, one of the hot questions we always get, Jeff, is the vacation property. And obviously this in Minnesota, it's a hot topic, either Florida or Arizona, wherever people want a vacation. How do you exchange, say, a residential property here, a rental property, excuse me, into your permanent residence, say down in Florida or Arizona, wherever you may want to go?
Both the relinquished property that you sell and the replacement property that you buy have to be held for a qualified purpose of investment or for use in your trade or business. So initially, Matt, when you buy that Florida condo or that townhome in Arizona or that lake cabin in Grand Marais, those properties in your mind initially have to be held for investment or business purposes. So would you like to rent out that replacement property, say for 24 months, to substantiate, walk the walk and talk the talk that you are holding for investment or business? I think if you are willing to rent your replacement property out and really show that you're holding it for a qualified purpose, you can do a 1031 exchange into it. But your long-term intentions may be more indeterminate, and you may choose to convert that to your personal residence, you know, some years down the road after the dust has settled on your exchange. That, I think, is the trick. But what I don't think works is selling investment or business property and immediately buying a property that you're going to use for personal use, because personal use right out of the gate is antithetical, completely opposite to holding for a qualified purpose. I talk to people that are doing that all the time. And, you know, everybody wants to have their cake and eat it too. We got a little bit of dead time here. Matt, can you hear me?
Yeah, you're breaking up a little on me. I don't know if it's just me or if anyone else is seeing that. If any of my people could ping me and let me know if maybe it's just me, but Ah, just me. All right. Okay. We'll work on the technical thing here for myself. Apologize for that. I'm going to keep reading the questions then. So I'm going to read them as they came in here.
Sure.
Is it then important to put each oh shoot, hang on. Is it important to put each property that we own into an LLC? I have a large number of, but I have a large umbrella policy that covers me. If I was to get sued for a slip or fall of a bunch of single member LLCs, can a person sue me, puncture my LLC by buying a single share off? This may not be 1031 related now I'm reading through it. So do you have any comments on that? You still have me, by the way?
Yeah, I still have
Okay.
you. You know, an individual that's doing an exchange can buy his or her replacement property in their own individual name, which is what we customarily see happen. And if you do buy property in your own individual name, like the questioner asked, you probably want to have a really good insurance policy, umbrella policy to protect you. But as you get more and more properties and you become more and more risk adverse, your dream team of advisors may suggest to you to compartmentalize the liability by putting each of your replacement assets into a separate disregarded entity, which is usually an LLC, so that each property is on its own separate silo. And the liability is kind of contained in that silo, so that if there is an accident or a claim, they sue the property owner. It's the LLC that's being sued, not all of the other entities that you have. And so that's really the genesis of the question. Matt, I think that most small investors are probably better off staying in their individual capacity, because I think it's easier to borrow money from banks like US Bank when you're going as an individual rather than an LLC. But at some point, when you get maybe 4 or 5 properties, now you're starting to get up to a level where you got to borrow money at the commercial window anyway. And being an LLC isn't that much of a additional bureaucratic challenge. Well, let me ask you this. When you're doing deals, Matt, do you see a lot of people borrowing money in their entities or borrowing money at their individual in their own names?
Yeah, if it's like a single family or 4-unit or under, typically they do it through their own name a lot. Some do it through an LLC, but most of the borrowing gets done through our home mortgage or US Bank home mortgage or another mortgage company, because those are, I mean, the rates are better. You get a 30-year fixed, just usually get approved.
You know, that kind of leads to another, thing. People kind of want to speak out of both sides of their mouth. They want to tell the IRS that this single family rental is their investment or business property, but they want to tell the bank underwriter that it's their second home or their primary even. And I think you got to make sure that the loan underwriter has the right information, because eventually that loan underwriter is going to see your closing statement that shows 1031 funds coming in, and it's going to be clear that you're buying this for investment or business purposes. But if you tell the bank underwriter the wrong information at the outset, they're totally underwriting this under a different risk parameter. So be straight up with your lender. Be frank with your lender. Get the right product from the outset.
And people do, I mean, you get a better rate if it's a second home. I understand that, but investment properties, typically, it's not much higher. It's a little bit higher. And right now, rates are phenomenal anyway, so it doesn't really matter.
Absolutely. I mean, these interest rates are great. If I could, I would buy everything I could and lock it in long and low, because I think after 2024, we're going to see interest rates going back up to what they would normally be. And we might even see some inflation.
Yeah, agreed. Okay, I got another one here. 18 months should be enough to satisfy the 1031 holding period, question mark.
Mm-hmm. Well, that's the question. You could ask 4 people that question and you will get 4 right answers. Nobody really knows. In the realm of rental pools, let's say that you bought a replacement property, Matt, and you put it into an Airbnb intermittent rental program. Down in Florida, particularly in the Florida Keys, There's management companies that all they do is just keep properties filled up for owners. Same thing up in Grand Marais, Minnesota. There's management companies that are renting out lake cabins for owners. Well, the question is, how long does the IRS scrutinize that property after you acquire it and put it into a rental pool program to make sure that you're really using it for investment or business purposes and not using it so extensively for personal use that it's no longer investment or business or qualifying property? In the IRS's own safe harbor, they examine the 2 12-month periods after you acquire the property. So if you extrapolate that 2 12-month periods is the standard for the IRS's own safe harbor for rental pools, maybe we should then say, well, 18 months might be a little on the skinny side. Maybe we should adhere to the 24-month standard. But there's great diversity of opinion, and reasonable people differ about what is an adequate holding period. Some say 12 months, some say just cross into a new tax year, and some people say, you know, hold it a solid 24 months before you get cute and do something inconsistent with holding for investment or business. I don't know if anyone can tell you affirmatively with 100% confidence they know the answer to that question.
Okay, thanks, Jeff. This one did not come from a banker. It says, how does debt affect a 1031?
Excellent. Debt is your friend, and don't be afraid. Do not fear the creditor. I think that's a song, right? Do not fear the creditor. Some people that are selling highly appreciated real estate but have to pay off a mortgage on the old relinquished property, they only want to reinvest their cash proceeds into a new property that they will own free and clear. Gosh, wouldn't that feel great to be debt free? However, when you're doing a 1031 exchange, there are 3 benchmarks that you need to think about. Those 3 benchmarks are, you got to go up or equal in value, you got to go up or equal in equity, and here's the kicker, Matt, you got to offset your debt relief. The debt relief can be offset by either taking out new debt on the replacement property, like taking out a mortgage or a deed of trust on the replacement property, or you can also offset debt relief by adding your own cash into the deal. But, you know, people want to put on those blinders and just, I only am going to reinvest my equity. I'm disregarding that I have to acquire equal or greater value, and I'm disregarding that I have to offset my debt relief. But if you want to squeeze all of the tax efficiency out of a 1031, you need to know what the accounting rules are. And you probably want to take out debt on the replacement side so that you get all of that tax efficiency. And this goes back to the DST question, Matt, because when you buy into a leveraged DST, where the underlying assets inside of the Delaware Statutory Trust are already mortgaged, you're picking up debt for tax purposes that encumbers the underlying portfolio. You're deemed to have acquired your proportionate share of the debt, even though you never signed that mortgage. You're taking the property subject to the debt. So that's a great way to offset your debt relief by taking on non-recourse debt that you're not even personally liable for. It's not really even on your balance sheet from a creditor's perspective. And that's a great way to have your cake and eat it too.
All right, I think you, let's see, I got a question on hunting land. So what if replacement property is mixed use, row crop and hunting land?
Every fall, I get people that are just so eager to buy that land up by, northern Minnesota, up by St. Cloud, Sauk Center. Why do you think they're so eager to buy that land come every fall? It's because in addition to holding the property for investment or business purposes, they may want to go up there with their shotgun and walk the fields and kick up a grouse or whatever they're going to do. Hunting land makes the hair on the back of my neck stand up, because if you use the property too extensively for your own fun and amusement and recreation, arguably you're not buying it for investment or business purposes. But if you buy land and you really use it for agribusiness or forestry business or hold it for appreciation, that definitely qualifies. But when you start using the property too much for personal use, like your hobby is hunting, now we might have a problem. I think that you can have a primary intent, which is to hold for investment or business, and you may have an ancillary benefit that you have a place to go and shoot a grouse or go duck hunting once in a while, but that only happens, you know, in very narrow circumstances during a very limited hunting season. The bulk of the time, the real estate is used for a qualifying purpose. Again, surround yourself with the best and brightest accountants and lawyers. Make sure that you're not doing things that are inconsistent with qualification for 1031.
All right, great. Hey, I got a few more coming in, but I do have I want to get to a couple that I wanted to make sure we addressed. I think you want to as well. Rumor has it that the 1031 code might be changing and that Congress might change it. Can you comment on that?
Well, Matt, the uncertainty that we live in is that the Senate is not 100% controlled by the Republicans like it was before, or at least, you know, majority controlled by the Republicans. So you have the executive branch, you have the House, you have the Senate. And if one party controls all of those different parts of our governmental system, it's more likely that significant changes in the tax code could be pushed through. And it has been telegraphed to us in July of last year by then President-elect Biden that he wanted to reform or change Section 1031. It has also been telegraphed to us that they want to raise taxes, capital gains taxes, and raise the brackets, the brackets on the amount that you're subject to back up to like 39.6%. So who knows what's going to happen? But if I was in government and I looked at the state of the international economy as well as the US economy, I would be reluctant to do anything that would adversely hamper our economic growth. And taxes can be used for social reform. It can be used for wealth redistribution. It can be used to stimulate economic growth. And I would be cautious right now if I was in government to do anything that would hamper our recovery. The rippling effects internationally of this COVID pandemic and how that's going to play out, we don't know. I would keep the pedal to the metal for tax stimulation right now and not raise taxes or eliminate provisions like 1031 that really help capital move to the most advantageous investment that organically creates economic growth. We need provisions like 1031. We will continue to need provisions like 1031 even more if they raise the tax rates up on capital gains. You're going to need to have a way to keep the economy growing and have velocity in the marketplace. If you eliminate 1031, which in the past, Congress has done things to the tax code that has really hurt investment, like the 86 tax reform killed real estate for a long time. You will see jobs eliminated. You will see properties deteriorate. You will see property values decline, and you will see lots of foreclosures and banks having to take back properties. None of us want that. We want to have jobs. We want to have properties appreciate because we want to have more workforce housing. We want to have more infrastructure. We want to have more warehouses and more velocity in the marketplace. But the economy is changing quickly. Think about how things are differing now that we've been in the COVID lockdown modality for about a year. You know, downtowns like Minneapolis, San Francisco, Manhattan, they have all of this office space, and hell, I don't even know if we're going to need it or even want it, because everyone's going to be working remotely. It's going to be a very different world that we come out into after this storm is over. I would be cautious to change anything in the tax code that will exasperate the difficulties that we're having now and will continue to have as we work our way through this pandemic. That's my advice to Congress. Be careful.
All right. Speaking of the IRS or the government, how often do you see 1031 exchanges reviewed by the IRS?
In the area of personal use, like lake cabins, ski chalets, condos that may be used for personal use, I think that's where you're going to see and have seen a lot of scrutiny. And it's not just the IRS, it's also the state collection authorities like the Minnesota Department of Revenue, the California Franchise Tax Board. These states are aggressive, even perhaps more aggressive than the IRS, and the states don't have the luxury of being able to print currency. So how are they going to get the money to pay for their bills? They are going to work hard to ramp up collections. So in the area of personal use, you see a lot of scrutiny. Also, larger transactions tend to garner more attention from the IRS. So the bigger your deal, the more likely I think that they're going to come and take a look at you, because the chances for a larger collection are proportionate to the size of the deal. So if you're doing a $90 million 1031, I'm thinking it's probably a good chance someone's going to look at that. But if you're only doing a $9,000 1031, there's really no gravy for the IRS to scrutinize it. So there's a lesser chance of scrutiny there.
All right, another question we had is, how soon after your 1031 expires, say you don't find a replacement property, how soon can you get your funds?
That's a good question, Matt. And a lot of the uncomfortable conversations that I have are with taxpayers who eagerly engaged us to hold their money in a separate segregated 1031 escrow account because they did not want to have actual or constructive receipt of their funds. They hired us to hold their money. And then later on, they change their tune and they say, oh, I want to fold up my tent. I don't want to do a 1031. Give me back my money. Well, let's just talk about how the Treasury regulations work. For the first 45 days after you sell your relinquished property, you have 45 days to identify the replacement property. If you don't make an identification, Matt, or if you revoke your identification, what happens at midnight of the 45th day? Your exchange fails. So if you want to, tank your 1031 exchange, the best way to do it is to not identify or revoke your identification so the exchange fails at midnight of the 45th day, at which point the intermediary will return your funds, typically by wire transfer, the next business day that the banks are open for transfers, and we can return your funds. The difficult situation comes when Matt will identify 3 replacement properties. And let's say that you close on one of those 3 properties, but you still have unused funds in your exchange account, and the other 2 properties fall out of bed. They just are not suitable for you. And you want to get your cash back. If you're in that period between the 45th day and the 180th day, and you've already acquired a replacement property, you still have 2 identified properties on the chopping block, you're in a tough predicament because the intermediary can't release your funds to you without jeopardizing your exchange or their role as an intermediary, I would argue. So you got to be cautious. In that situation, your money may be tied up until the 180th day, and you may not be able to get the remainder of your unused funds until the 180th day has elapsed. Them's the rules. You wanted to do the exchange and you wanted to be insulated from receiving your funds when it was, advantageous. You may have to be patient and work your way through. (1031s) are delicate creatures, but they always end after 180 days. That's the good news. You're going to get your unused funds back, and your funds are always immediately available for you to purchase your identified property. You just may not have the ability to put your hand in the cookie jar and grab the cash out anytime you want without having a bogus 1031.
All right, another question got sent to me. We hear this often. Say you got the family cabin, you may rent it out in the summer a little bit, who knows, right? But how much would you need to show that you rented the family cabin out in order to do a 1031 into, say, a commercial property or like an apartment complex? Or how long, maybe?
Matt, my own family faced this problem with a highly appreciated cabin in Baldwin, Wisconsin, that was never used for rental purposes at all. It was used for jet skiing, barbecuing, playing cards, and hanging out for personal use. And we could have rehabilitated that personal use property and brought it back into the strike zone for 1031 by renting out the lake cabin. We could have put tenants in that property and we could have abstained from using it ourselves. But it was just too much of a hassle. And cabins kind of have an emotional thing, like it's kind of part of your family. You don't want to rent it out. So we decided to just pay the taxes. But you could reconfigure how you treat that property for some period of time to bring it back into the strike zone. Remember, we talked about the IRS has that safe harbor for rental pool property where they examine the 2 12-month periods. That is applicable in the inverse as well. So it could be applied to the relinquished property. So for 2 12-month periods, you could put your cabin into an Airbnb or a VBRO rental pool kind of program and really rent it out at least 14 days in each of those 2 12-month periods. And you could abstain from personal use and stay under their thresholds, which are 14 days in each of the 2 12-month periods, or up to 10% of the time that the property is rented out. So to answer this question, if you want to adhere to the IRS safe harbor, work with your accountant to put it into a rental pool program for 2 12-month periods, or a total of 24 months. Adhere to that safe harbor, really rent it out, and then you can sell your cabin and do a 1031 because you brought it back into the world of investment or business purposes. Good questions, really good.
Yeah, I think I've answered most of them. Jeff, is there anything that you think we should cover that has not been asked yet?
Well, the thing that I'm seeing people have an epiphany about right now is that it is expensive to buy replacement real estate. It's so expensive because it's so competitive. And people are saying, well, why would I pay top dollar for this apartment building that was constructed in 1960 and has all of this deferred maintenance when I could buy land and I could construct my own brand new apartment building? Even with construction costs and shortages of lumber, I still come out paying roughly the same thing. And I've got brand new, freshly built property just the way I like it. So we're seeing people have this epiphany that, hey, I think I need to do a build to suit exchange where the intermediary uses the exchange funds to buy raw land and holds title to that raw land while real property improvements are constructed and exist as real estate, so that you're receiving your own replacement property that you've had built to your own specifications. And we're seeing this a lot with small business owners that are moving out of the urban core where they're confined in small spaces that are too small for them, and they're moving out to places like Ramsey, they're moving out to Lakeville, they're moving out further out of the metro area where land is less costly, and the cities will let them build brand new big facilities where they can grow and expand their businesses. So build to suit exchanges are really the ticket that I see people really exploring a lot in the last like 4 months. That is a hot topic. I think another topic that we see a lot of people worrying about is buying from a related person. When you buy your replacement property, you kind of prefer to buy the devil you know rather than the devil you don't know. But the IRS has created rules that make it more difficult to buy from a related person. And again, you need to surround yourself with the best and brightest, but your accountant, your lawyer, and your intermediary all need to be helping you if you're doing a related party transaction, particularly if you're buying the replacement property from a related person. But many farmers want to buy the farm that's adjacent to the home farm. And guess what? That neighbor might be your brother or your ancestral or lineal descendant, but it doesn't make sense to buy another farm across the county. You want to buy the farm that's close to your home farm because the synergies are better when you buy in closer proximity. So particularly for agricultural exchangers, there may be limitations on what you can buy, and you may need to buy from a related party. You've got a reason though. So look out for related party transactions. That can be a tough area to navigate. Matt, I see a lot of people talking about post-exchange refinances, and many bankers are exuberant and want to loan you as much money as you qualify to borrow. They will loan you as high as they can. But remember, in a 1031 exchange, you need to find a home for your equity. You've got radioactive proceeds from the sale of your relinquished property. What do you do with radioactive material? You don't put it in your own pocket. You got to put that radioactive cash into the replacement property. So if I'm bringing in $300,000 as my downstroke, my down payment, when you would ordinarily only require a down payment of $100,000, the banker's going to be scratching their head saying, why aren't they borrowing more money? Well, Matt, I think the answer is tailor the loan to the 1031 exchange so they don't over borrow at the moment of acquisition. And they acquire a property of equal or greater value, equal or greater equity. They offset whatever debt they had, but tailor your loan. And then later,
All right. Hey.
What are you going to do? You're going to go back to them and you're going to refinance their replacement property in a later subsequent transaction after the dust is settled. Go visit your client a couple months after the exchange is done with so you can get that excess equity out.
All right, we're at the top of the hour here, and we're out of time. So I do want to thank Jeff and everyone who joined. Obviously, if you were invited by one of my bankers, please reach out to them. If you need a banker, my email is really easy. It's matthew.thompson@usbank.com. Jeff, again, great webinar as usual. You have any closing comments, Jeff?
I just want to say I'm available to talk to people. That's all I do is talk to people on the phone. My phone number is 612-643-1031. 612-643-1031. I'm Jeff P. at CPEC1031, and I am stoked to have done another wonderful presentation with you guys at US Bank. Thanks, Matt.
Hey, thank you. All right. Everyone have a good day. Appreciate it. Thank you.
Bye now.